So we did Dunkin Donuts, and I'm Dan.
I'm Steve.
I'm Katie.
I'm Billy.
And the reason it says Dunkin Brands is that it's the parent company to Dunkin Donuts. So Dunkin Donuts the first Dunkin Donuts was opened in 1950 by Bill Rosenberg in Quincy, Massachusetts. And today it's headquartered in Canton, Mass. And the first franchise opened in 1955. And this is very important for the company as a whole because today nearly 100% of all Dunkin Donuts are franchise locations. It was purchased in 1993 by Allied which was then acquired by a competitor, Pernod Ricard, in 2005. And after the absorption of Allied, Pernod Ricard looked to sell what would soon become Dunkin Brands, and they found a seller in a consortium of private equity firms, one being Bain Capital, and that sold for $2.4 billion. Dunkin Brands was incorporated in 2005 after the sale. And it went public in 2011 with an IPO of $25, and once it went public, it sold 22 million shares of Dunkin stock, which raised the company $422 million. And since 2003, there have been an opening of 3,500 Dunkin Donuts locations worldwide. Dunkin Donuts Performance. They are one of the QSR leaders in both hot and iced coffee, as well as muffins, bagels, donuts, and breakfast sandwiches. In 2013, they grew revenues by 8.5%, and this is due to a steady increase in both the U.S. and international markets. They saw a rise in assets, equity, net sales in both operating and net income, while simultaneously seeing a drop in total liabilities. And annually, they serve 1 billion cups of coffee, which is very important for the company as a whole, due to the fact that they're trying to shift their company from a donut and pastry business to a beverage business. And their CFO has been quoted on saying that they are a beverage company, which makes sense due to the fact that 58% of their revenues come from their beverage sales.
Alright, now we're going to look at Dunkin Brands' financial performance. So to start with liquidity, we use one thing for working capital, which is current assets minus current liabilities. In 2013, it was $117,462, meaning they had that much more current assets than liabilities, but an even better ratio to measure the liquidity would be the current ratio. It's been fluctuating, but in the past 3 years, 2013 has been the high at 1.34 to 1, meaning that for every dollar of current liabilities, they have $1.34 of current assets. Next was solvency. We use the debt to asset ratio. Now these numbers are very high. It's at 87% in 2013, and this is because of the rapid expansion Dunkin Donuts has been doing, moving across west and to the west and globally. And then looking at the profitability of the company, earnings per share, which is the net income received from each share of common stock, they had it at $1.36, which has risen over the past 3 years. Now we'll look at the competitors. Okay, so liquidity, Dunkin Donuts has less working capital than Starbucks and more than Einstein Brothers Bagels. Starbucks working capital is a lot bigger at $94.1 million because it's such a big company compared to Dunkin Donuts. But what was the big factor for Dunkin Donuts is that they have the better current ratio of 3 at 1.34 compared to Starbucks 1.12 and Einstein Brothers 1.12 and Starbucks 1.02. Looking at the solvency, all the debt to asset ratios are very high, and Dunkin Donuts had the best between 3 and 2013 at 87%. And then profitability, which is the success from operations. Starbucks earnings per share was $2.26, which was higher than Dunkin Donuts, but you can't really compare these numbers across the three because each company has a different amount of shares of outstanding stock.
So some of the current events that have been happening within the company. Currently, or as of December 5th, their stock was selling at $48.15 per share. And they do have plans to expand into different markets, such as more college campuses, to California, and more international locations. And last year, Dunkin Donuts was able to remodel over 600 of their stores in the United States. And then the impact that these current events have on their sales. Their stock selling price of $48.15 is a lot higher than the original selling price, which was $25. And Dunkin' Donuts expanding to more college campuses will help their sales a lot because studies have shown that 39% of people ages 18 to 24 drink coffee every day, so that can really help their sales. And Dunkin' Donuts has plans to move west into California. They have plans to open 63 stores in the next year, 250 in the next couple of years, and 1,000 as a long-term goal. Their main competitor will be Starbucks since it's so big in California. Right now there is about 2,000 Starbucks in California. So if Dunkin' Donuts is able to take a percentage of their customers, then their sales will increase. And one country that Dunkin' Donuts plans to expand internationally to is India, and they are Asia's third largest economy, and they have a population of 1.5 billion, whereas the U.S. only has about 315 million. So if Dunkin' Donuts was able to make about 147 million as a net income in 2013, this number will be much greater if they're able to expand internationally. And since they were able to remodel 600 of their stores in the United States, their customer satisfaction rating increased by 5 points from the year before.
Determinants of investing. Normally, pros and cons is the best way to approach it. You want to see what weighs out the others, and we felt that the pros weigh out the cons. 2013 saw a rise in sales, revenue, operating, and net income. That's a huge part of the company. Making money, being able to do new things like expanding into California or expanding into India, like Katie said, or how they're expanding into Brazil and opening 65 restaurants. They have a ton of restaurants in Latin America, which is huge, and so Dunkin' Donuts is doing very well and expanding. Dunkin' Donuts is reaching markets never before measured, as I just explained. Expanding to new markets can be risky. It may fail, but with risk comes reward, and that's what we found. And having Starbucks image be better is tough because they show no slowing down, but when it comes down to Starbucks, by expanding Dunkin' Donuts into California, where Starbucks has a lot of stores and restaurants, it's huge because then they can take the Starbucks customers and turn them into Dunkin' Donuts customers. Should you invest? In the end, we find that you should invest by leading in the QSR, which is quick service restaurants. They lead with hot iced coffee, bagels, muffins, donuts, and breakfast sandwiches. That's big because they're like #1 in all of that in comparison to Starbucks, who sells most of that category. They grew in revenue by 8.5% in 2013, and they show no slowing down. And their steady increase in revenue is continuing. And that's it.